If we could get everyone to please return to your seats and turn your attention to the screen for the introduction of our next presenter.
Patrick McCarthy is a certified public accountant licensed in Illinois and Iowa, practicing since 1990. Retiring on December 31st, 2021, Pat was principal and vice president of O'Connor, Brooks & Company, P.C., a public accounting firm with offices located in Galena, Illinois, and Dubuque, Iowa. He has been the lead auditor on audits of financial statements of numerous cities, villages, districts, and a variety of not-for-profit organizations operating in the states of Illinois, Iowa, and Wisconsin. Here to discuss the largest municipal fraud in U.S. history, where the municipality went wrong, and how to prevent this from happening at your organization. Please welcome Pat McCarthy.
Morning, everybody. As you saw on the screen, I've been in the auditing profession for about 35 years prior to my retirement. I'm going to talk a little bit about fraud mitigation, how you can prevent fraud in your organization, and what happens if you don't mitigate. And it can be pretty nasty. So let's start. Fiduciary responsibility. What is fiduciary responsibility? Those charged with governance would be the members of the board of directors. Their fiduciary responsibility is the safeguarding of assets that are owned by the company, the municipality, organization, whatever entity they're working for. They have the fiduciary responsibility to oversee the strategic direction, the accountability of the entity, and financial reporting process. Some of those charged with governance are CEOs of public companies, city council members, elected officers, city, county, state, federal, and members of the board of directors. I'd be willing to bet that there's a few people in this room that are members of board of directors for nonprofit organizations in your community, chambers of commerce, things of that nature. When you get on those boards, you accept that fiduciary responsibility. So this really applies to about everybody in the room. To fulfill your responsibility, you rely on certain things. You rely on management. Who's managing the organization? The employees, the staff of that organization, and internally generated information like your monthly financial statements, subsidiary ledgers. By subsidiary ledger, I'm talking about an aged account receivable report, your accounts payable report, depreciation schedules. Anybody who's an accountant in the room knows where I'm coming from. For those of you that are not, I'm going to try to keep it simple and eliminate as much of the accountingese as I can. But those are subsidiary ledgers. Those taken together really compile your financial statements. Budget comparative information, I'm sure most, if not all in this room have budgets. Forecast industry trends, plans of operation. I know you have plans of operation because I sat back there and listened to it. Pretty impressive, very impressive. There are also externally generated information that those charged with governance rely on, government reports, newsletters, organization newsletters, tax projections, which everybody's worried about tax projections, right? Employment forecasts. I mean, that's major for everybody. And the independent auditor's report. Now, everybody in the room is familiar with the auditor's report. You all get audited, you receive your report, look at it, unmodified opinion, everything is fine. Wash your hands and walk away. We just got the seal of approval. Folks, I'm here to tell you that that seal of approval does not exist when it comes to fraud. Do not hang your hat on the auditor's report. The auditor's report relates to the financial statement only. What is the independent auditor's report? It's a report on the entity's financial statements. And you can receive 4 different types of opinion. An unmodified opinion, which means that they have no comment on the financial statements, and they appear to be prepared in accordance with generally accepted accounting principles, GAAP. And that's probably, it should be anyway, what everybody in this room looks at when they get their audit. You may have a modified report that accepts an item out of that report. Inventory, for instance. Maybe the auditor wasn't able to observe inventory at the start of the period and observe it at the end of the period, so they may say financial statements are fine except for inventory, accounts receivable, whatever. That's called a modified report. The third option is a disclaimer where the auditor has no opinion on the financial statements. I've only issued a couple of those, and it's not because there was anything wrong with the financial statement. It's because there was a part of that whole financial statement taken as a whole that was missing. So in that case, your auditor is going to say everything is fine, everything's prepared in accordance with GAAP. However, we disclaim the financial statements taken as a whole because something was missing. Doesn't mean there's anything wrong with the financials. The last one is the one nobody wants, an adverse opinion. And basically what the auditor is telling the reader of the financial statements is it's not worth the paper it's written on. And you really don't want that. I was talking to Mr. Mattingly back here earlier, and I was telling him that I used to perform an audit for a company that had 25 locations in 4 different states. And they built a new facility, and they supplied some of the material to the contractor who built the new facility. And they also had a process in place where the supervisor would get a bonus based on sales. Well, the president of the board of directors said this is a fictitious sale because we're selling our product to the contractor, and in turn, this guy's getting a commission on it. What it boiled down to, he didn't want to pay the commission. But anyway, I said, no, this is not self-construction. You've got a general contractor, he hired this sub. There's no requirement in the contract that they buy anything from you. We even looked at the invoices to make sure that they were charging the right amount, that they weren't lower or higher than they should be, and everything was on the up and up. I mean, it was a sizable investment, like $1.5 million or something like that. And he said, well, we're going to exempt that out. We're not going to report the sales. And I looked at him and I said, well, they're your financial statements. You can do that. But understand, I'm giving you an adverse opinion. That was like knocking him over. He didn't like that at all. Tried to talk me out of it. And I said, no, you can't do this. This is going to mess your tax returns up for 40 years. Then I want you to explain to Internal Revenue Service and all the states' revenue services that you just took about $800,000 worth of sales out of your financial statement that you're not going to pay tax on. Well, needless to say, that was the last time we did that audit. but our company is still in existence, so. Now, what is not the auditor's report? It's not a 100% assurance of accuracy. There's a thing called materiality that's built into financial statement reporting. Financial statements can be off a certain amount and still considered to be in accordance with generally accepted accounting principles, and is definitely not an assurance that no fraud exists. It's not an assurance that your internal control structure is adequate. Everybody know what internal control structure is? If not, let me go through it real quick. It's basically the written policies that the company or the entity or the organization has in place that tells employees how to perform their duties. Your internal control structure, very important in any organization. Now, if you look at your auditor's report, I hope some of you actually do. I hope when you go back that you really take out your auditor's report and take a look at it. Because it's going to tell you a lot of things that I bet a lot of you don't bother reading. It's going to tell you management's responsibility for those financial statements. And it's also going to tell you that, guess what? Management is responsible for these statements. All we did was audit them. And all we did was opine on them to say that, yes, they're prepared in accordance with generally accepted accounting principles, or they're not. It's going to tell you that under the paragraph that's titled Auditor's Responsibility. It's going to tell you exactly what the auditor's responsibility is. And everybody who reads that financial statement, that audit report, is going to read that also. Besides the fact, when you guys signed your engagement letter with your auditing firm, tell you what, when I started doing this, we used to have a one-page engagement letter. When I left, it was 18 pages long. I'm serious. 18 pages, I'm thinking, what? They got everything covered here but your baby's diapers. I mean, it's unbelievable. They cover every contingency you can think of to try to protect themselves from any kind of liability that would result in some sort of a fraud or something like that. That's basically the opinion. This would be your unmodified opinion. The financial statements present fairly in all material respects the financial statements of XYZ company. Now, the heart of the matter is your internal control. Again, your written policies that tell employees how to process information. When an auditor goes in to audit, they're going to look at the internal control structure of the organization that they're auditing. And they're going to look for weaknesses. How do they reconcile cash? How do they reconcile accounts receivable? What about accounts payable? Inventory control, depreciation schedules. The reason the auditor is going to look at that part of your internal control is because they want to determine if there's a weak spot in that internal control. And if they determine that, that's where they're going to start testing. Because if there's going to be a misstatement, it's probably due to something that failed in your internal control. And depending on what kind of an audit you have, I'm not sure if co-ops are under government auditing standards or not. I don't know. Does anybody know? No? Okay. You may get another report other than the auditor's report that is a report on the internal control. And in that report, the auditor is going to basically talk about any deficiencies in your internal control structure. And basically, a deficiency is an internal control when a design or operation doesn't function and it doesn't allow management or those charged with governance an opportunity to correct. I have some things there that we're going to get at here in a little bit that'll kind of make that a little more apparent. Again, we're into the accounting ease part of the presentations, so I don't want to lose any of you. There's a material weakness, which is the biggest issue that most people have with failure of internal control. It's either one deficiency or a combination of deficiencies that result in the inability of the company and management to detect a material misstatement and correct it, whether due to fraud or error. So let's talk about that a little bit. So you get your audited report, you get your financial statements, and somebody embezzled $200,000 from the company. How does that affect the financial statements? It really doesn't. The $200,000 is reported as an expense, some sort of an expense, probably down at the bottom of the income statement, because that's exactly what it is. It's recognized in your income statement. It doesn't make the financial statements wrong. It's there. It's included. So you can see how important it is for internal control and the auditor's report, how they don't interrelate, not at all. Once an auditor may find weaknesses in your internal control structure, they will tell you about them, either in the internal control report or a letter to those charged with governance, the management letter. The most common that we see is a segregation of duties. Actually, it's a lack of segregation of duties. And if you don't leave this presentation with anything else but this one thought, I would really appreciate that you understand this thought. An important aspect of good system internal control accounting, okay, includes adequate segregation of duties. Here it is. So that no one individual handles a transaction from its inception to completion. That's the one thing I hope you take from this. If you have an organization that has few employees, which I would be willing to bet some of you do, you probably have a lack of segregation of duties issue here. If you have one person that handles a transaction from the beginning to the end, You got a weakness. If you have one person that writes the checks, signs the checks, mails the checks, picks up the mail, reconciles the checking account, records it in your general ledger, you've got a weakness. You've got a weakness, and it's going to come to fore later on in the presentation. A lot of times your auditor will make a suggestion to you. In this regard, we always suggested that, you know what, let's send the bank statements to the treasurer directly, unopened. He or she can open them up, look through it. The checks, does anything look funny? Are we missing a check? Is there a check out of sequence? Are they signed, endorsed properly? Things of that nature. And he or she can initial the envelope and give it back to the accountant or whoever is responsible for reconciling the account. Needless to say, the accounting profession is not particularly difficult, but not particularly popular either. I mean, some people say we're boring. I don't know, but I kind of like it. You know, I always did like numbers. So it takes a lot of education and experience to gain the knowledge to be able to prepare these financial statements, especially if you're using especially if you're using government auditing standards. And I'm not sure about co-ops, but I bet you are. So the auditor understands, hey, you know, I'm dealing with a co-op here that's got 50 employees, maybe 3 or 4 people in the office, or maybe 10 or 20, it doesn't make any difference. Be willing to bet that none of them know how to prepare these financial statements and disclosures, and you wouldn't be expected to. Your job is to manage the company. But you still have a fiduciary responsibility to that organization. So your auditor is going to tell you, you know what, we understand that you don't have the expertise to prepare these financial statements, so we're going to recommend that, you know, take a couple of courses, maybe sign up for some literature to expand your knowledge of generally accepted accounting principles, get a little bit more of an understanding of what's really going on in the accounting world. And definitely when you perform an audit, you're going to catch things that are misstated. Maybe something got credited to the wrong account or debited to the wrong expense account. The auditor will tell management about those instances, and they'll propose adjusting journal entries that management will approve, or they're going to get an adverse opinion. They will approve, and then the financial statements will be issued. So, those charged with governance, the members of the boards of directors, your auditor is telling you, hey, there's a weakness here. We found examples throughout your financial statement where we had to reclassify entries. And we told management about it. Management agreed. They made the entries. But you, as those charged with governance, need to be aware of that. And I'm probably going to recommend that, you know what? Stay involved in the accounting and financial reporting part of the process. Ask questions. If you don't understand something on your financial statement or something seems a little bit fuzzy, ask. There's a difference between a significant deficiency and material weakness, where a significant deficiency would be something that may not misstate the financial statements, but we would want you to know about anyway. So I'll bet you everybody in the room here has budgets. So when you get your monthly financial statement, are you looking at current numbers compared to budget? This is where we thought we were going to be. This is where we are. How are we doing? Are you looking at month to month? Are you looking at year to date to year to date? You should be. If you're not, you're probably going to get a comment from your auditor that says, you know, you guys created this wonderful budget. You don't pay any attention until the end of the year. That's really not what it's for, even though your accounting system has the capability to issue those financial statements. So your auditor may tell you, we think you should do that. So we've covered a lot of stuff here: auditors' reports, internal control, opinions on financial statements, material weaknesses, which is really hard to understand. In all honesty, I bet you I audited for 5 years before I got a real good grasp on the problems and the issues that can come forth with internal control. Your auditor is here to help. ask questions. Okay, let's look at some individual issues with your internal control structure. Is information available to those charged with governance on a regular basis? Board of directors, city council? You get it on monthly? Is comparative data presented? Not only budget, but this year compared to last year, same month, year to date? Those are important things because if you're looking at financial statements, you want to see any big fluctuation that may jump at you and say, whoa, where'd this number come from? Budget to actual, current year to prior period. Now, here's a question. Is your management team dominated by a single individual? I bet a lot of people are thinking, yeah, maybe. Okay? That's an issue. That's an issue. What about authorizations? Do you use purchase orders? What about signing checks? Does a check need to be signed by more than one person? 2 people or 1 person? Are written policies in place that tell your employees how to manage the company? What process they have to go to achieve their daily goals? How about minutes of board of directors meetings? This is my favorite. One of the first things I always did when I was auditing was read those minutes. And they should be in writing. They have to be. Well, they don't have to be anymore with this electronic age we're in. In fact, I looked at a couple of them the last couple of years before I retired that were electronic. I didn't like it as much, but oh well. Who is in charge of the selection of vendors? Who makes that decision? Who says, well, we're going to start buying our material from Joe Blow over here? Who makes that call? Now, for those charged with governance, people sitting on the boards of directors, do you have a relationship with an attorney? The co-op does, I'll bet you. But I bet you any board that you're sitting on outside of your organization does not. And if you don't, you want to. They're probably not going to join the board because they accept a certain amount of liability when they do that. But I'll bet they would have an informal relationship with you that you could bounce things off of should you have to. How about tax returns? Tax returns filed? And if they're filed, do they match the financial statements? Sounds crazy, doesn't it? But it happens. If there's a fraud going on, the financial statements may be misstated, but you can bet the tax returns are stated properly because nobody wants to go to jail for filing fraudulent tax return. If you embezzle some money from someone, yeah, you're going to be guilty. You're going to be a felon, all right? But you know what? That money's already spent. It's gone. What are they going to do to you? They're going to obtain a judgment against you, and you're going to pay them $50 a month for the rest of your life. And then you're going to stop paying after 6 months, and the whole thing goes away. I mean, that's what happens. I'm sorry. Fraud risks. Okay, this is where we're talking about one person in charge of a transaction from inception to completion and custody of assets. Who's in charge of the checks? Who controls the petty cash amounts? Who has access to savings accounts? Who has authority? Who can authorize a transaction? Who has the authority to sign a check, wire transfers, making deposits? Who has that authority? Is it one individual? Opportunity, a lack of segregation of duties. There you go. The same person does multiple functions, receiving, depositing, recording, receipts, and then recording them in the general ledger. So you see how this can be an issue, right? If I'm taking a transaction from the get-go, I'm writing a check, reconciling the checking account, recording it in the general ledger, do you think I have an opportunity here to perpetrate a fraud? Yeah, absolutely. And when we get into that fraud arena, now is when you really have to be wary. In fact, I'll tell you right now, if fraud is occurring in your organization, it's been going on for probably 3 months. I attended an event one time, and the speaker made a perfect point. He said, when the economy is going strong and gross domestic product is increasing, employment is high, net income is good, the occurrence of fraud is reduced. When the economy turns south and things start to change, guess what happens? The occurrence of fraud increases because of pressure that may be put on an individual with an economy that's in a downturn. And we all know, the numbers came out yesterday, we're in recession. Some people don't think we are, but we're in recession. So if there's fraud that's occurring anywhere in your organizations, it's probably been going on for a couple of months. Now, who would commit fraud? Which one of these three people do you suppose would perpetrate a fraud? And how can you mitigate the possibilities of fraud occurring on your watch? Here's the saying that I want you to remember. No one individual is involved in a transaction from inception to completion by themselves. Who controls accounts receivable? Is there procedures in place for approving new customers? Who approves a new customer? Management? Does management tell the board of directors, those charged with governance? How about issuing credit? Issuing refunds, discounts, or write-offs? Any write-off should absolutely come before the board of directors and be approved by those charged with governance. That should be out of management's hands. You can limit access to the records. Accounts receivable listings need to match the financial statements every single month. That's your subsidiary ledger. You probably get an aged receivable report that shows current, 30, 60, 90, over 120 days. Total on the bottom of that ledger should match the accounts receivable on your financial statements. Believe it or not, I've seen numerous times where they don't match. And when you ask questions, you finally get to the bottom of it. And it normally isn't any kind of a fraud issue, but it happens. There you go, ways to mitigate. No one individual involved in a transaction all by themselves. Control the mail. Use a post office box to limit access to the mail that the organization may receive. Have someone without responsibility for recording or depositing pick that mail up. No individual responsible in a transaction from inception to beginning. Control the bank statements. We talked about this. You may get a suggestion from your auditor to do that. They should be looking for missing checks, checks out of sequence, unknown payees, checks that appear to be altered. One of my favorite stories, I was an expert witness in a divorce case, and there was a couple of businesses involved, and I happened to be on the side of the female. This is where you want to be, guys, believe me. But I was on that particular side, and we had copies of all of the bank statements and canceled checks for a couple-year period. And we would go through these, and we kept coming out about $50,000 off. We're short 50 grand. Couldn't figure it out. So I said to the attorney, I said, we're looking at copies here. Let's see if we can get the originals. Went to the judge, and the judge sent them originals. Now we had the original checks. So we started going through this. And the attorney was sitting next to me, and he just gasped and went, I looked, I said, what? I thought he was having a heart attack. He said, look at this. And he handed me a check. This is the original check. And I think it was written to cash, if I'm not mistaken. And the original amount was whited out, and $500 was written in. But when you looked on the bank statement, that check cleared the bank for $50,000. Okay? So you see how this stuff can happen. Needless to say, the judge really was not happy with that one. He didn't like that at all. Accounts payable, who approves new vendors? If there's a fraud scheme in place, they probably have an outside person they're working with, so be careful of that. Are the bills approved by the board of directors? And is that included in the minutes of the board of directors? Should be. Are dual signatures required on checks? General oversight that you can perform as those charged with governance: look at your monthly financials, look at the budget comparisons, and here we are with the three individuals again. Which one of those three do you suppose would commit fraud? You can't tell. You can't tell by looking at people. You just can't tell. If somebody has the custody, the authority, and the opportunity to commit fraud, you have to watch out. You have to be careful of that. All right, let's talk about some indicators of fraud. I want you to be alert for employees with maybe not a good attitude or a bad attitude, lifestyles, behavior. How about dissatisfaction with compensation, or maybe a lack of promotion, unhappy employee? Maybe they have a gambling problem, drug or alcohol use that you may have heard from the grapevine about. How about financial distress? That goes back to the theory that when the economy starts to tank, fraud occurrence starts to increase. Excessive nervousness. When you walk by, do they get real nervous? Do they cover stuff up? You know? How about vacation policies? Doesn't sound like much, right? What if you have a mandatory vacation policy and somebody's not using it? It happens. Why? Why is that person there for extra hours every day? How come everybody goes home at 5 and he or she is still there at 8 o'clock, Monday through Friday, when no one else is around? Be alert for employees living above their means. Fancy cars, horses, we'll talk about that in a bit. Motorhomes, talk about that. Lavish vacations. Restricted assets. Restrict those assets so only certain employees can access certain parts of your financial statement accounting. How about they can never provide information when they're asked for some? Maybe they avoid the question. If you suspect fraud, what do I do? Okay, Pat, you're telling me all these wonderful things. Now what do I do? Well, if you're a member of the board of directors, you suspect fraud is going on, go to the chairman of the board, first off. What if you expect the chairman? What do you think it's him? Then you know what? Then talk to your other board members. Talk to other people, because you're not the only one charged with governance. Everybody on that governing body is. And everybody has the same issues that are on that body. And if you're still not satisfied, you better talk to an attorney, individually. And if the issue is not getting resolved, after all these things you've done, you better think about quitting. And you better get off of that board. And definitely talk to your attorney at that point. Because you have the fiduciary responsibility to that organization. And when fraud occurs, people get angry. Get angry. They start looking for somebody to blame. And it gets expensive. Okay, examples of local fraud. Unauthorized electronic funds payment. You know, I don't know how these guys do it, but they do. We were performing an audit in a town, and one of the people who was on staff came up to me and said, I can't figure out what's going on with this cash account. What do you mean? I said, well, last week, there was 2 transfers, wire transfers of $15,000 each down to Texas. And this is in Freeport, Illinois. Thinking, Texas, that doesn't make any sense. Let's go talk to the CEO. Went in to talk to the CEO and said, what are these? He went, I don't know what they are. I said, well, maybe we should call the bank. Called the bank. Said, who authorized these transactions? I said, nobody. They just occurred. Somebody in Texas got your information and pulled $15,000 out of your account twice. And the CEO wasn't happy. I said, well, what the heck, you know, you're our bank, this shouldn't be happening. So the banker says to him, she had him on speakerphone. The banker says, well, what do you want me to do about the $30,000 that's scheduled to come out at 2 o'clock today? Serious. Serious. Watch those unauthorized transactions, because once they're gone, they're gone. I mean, you can talk to FBI all you want, but I'll tell you what, unless it's $1 million or more in fraud, the FBI will not even look at it. They won't look at it. False payroll. You think it doesn't happen? It does. We were auditing again someplace in the Quad Cities, I believe, if I'm not mistaken, and we looked at the payroll this year, prior year to budget. Wow, way higher. It's like 25% higher. I'm going, wow, what's going on here? Let's go talk to the CEO, talk again. Her face got real red, and she said, well, you know the person that usually works with the audit? Yeah, I said, I noticed she's not here anymore. She quit 2 weeks ago, just before you guys came in. So this individual was kind of a person who was real busy, like a lot of them are, like a lot of people in this room are, okay? And the payroll was on Friday, so the person performing the payroll would come in, put the prepared checks in front of the CEO, and she'd, here you go. Didn't even look at him. One Monday, the individual came in and said, oh, you know what? I forgot to process this payroll check. Would you sign it? Sure. Sign that one. Boom. That's where it started. Those checks were all made out to her. I don't know how much she ripped them off, like 50 grand or something like that. But again, what are you going to get? You're going to take them to court and obtain a judgment that they'll pay $50 a month for 6 months and then toodaloo? That's pretty much it. What about cash receipts? Anybody who's a member of a city council or anybody, we actually had this happen one time, kind of comical. They had a system similar to this where they would reconcile cash received each day. So in this case, they had $1,300 worth of cash, $20 was paid out, $10 was recorded wrong, so the net cash should have been $1,289 some odd cents, includes cash checks and credit card amounts. But when they totaled it up, they were $20 short. So the person who was doing the reconciliation went through it 3 times. Boom, boom, boom. And every time was $20 short. Damn, it's Tuesday and I got a bowl at 5 o'clock. Doggone it, it's 20 after 4, I'm out of here. Reaches in the pocket and takes out a $20 bill, sticks it in the envelope and seals it. Passes it to the next person. In this case, their internal control structure worked perfectly. Because the next day, the person who was re-reconciling opened it up, went through it, and guess what? She's $20 over now. The first person made the same mistake every 3 times. Put the $20 in because she wanted to go bowling. Their internal control worked because they caught it. But I still wrote them up in the auditor's report because it was a violation of policy. All she had to do was say, we're $20 short. Doesn't make her a bad person. Nobody thinks she stole it. I mean, people make mistakes. Don't compound the mistake by making it worse. Here's an invoice that I'm just going to give you a brief look at. We're going to look at this in greater detail here in just a few minutes. But when your auditor goes in, they're going to try to substantiate expenses based on existing documentation, including invoices. So they'll try to tie out checks that were paid to the amounts recorded on the invoice, to amounts approved by those charged with governance, management, whatever your internal control structures are. This is a desk that looks a little bit like the CEO that had the payroll issue. You can see, you know, not the neatest thing in the world. You got some stuff there on the floor, and I don't know where you perform any work on those desks because there isn't any wood showing. But anyway, watch out for stuff like that. If you have an individual that seems to be not well organized, you might want to be careful. Now, there's only one safeguard that you can get against fraud, and that's insurance. Not an insurance person, never sold a policy in my life. I'm just telling you that if you suffer a fraud, if your organization suffers a fraud, the only way you're going to get recovery is through your insurance company. Again, you can sue the perpetrator if you can find them, but the money that they stole is already spent. There's a reason they took it. They don't have enough. So you can take them to court. They can be found guilty. You can get a judgment against them. You're paying back this $300,000 and you're paying it back tomorrow. Really? And how am I going to do that on unemployment? So the judge says, judgment against the defendant, pay $50 a month until full restitution. You know how many months it takes at $50 a month to pay that kind of money back? You can't live long enough. And what happens 6 months down the road when this individual picks up and moves to another state? Or they just quit paying you. You can't get blood out of a turnip, folks. You can't do it. But insurance is your most likely means of recovery. You need to continue oversight. You need to ask questions. You have to make sure that the questions are being answered properly. They're not being evaded. You don't get an incomplete answer. And does the answer make sense? If it doesn't make sense, ask it again. Trustworthy. Can't tell by appearance. You cannot tell. Now we're going to talk a little bit about the biggest fraud that ever occurred in the history of the United States. I don't know, I imagine someone from here is aware of Dixon, Illinois. Up from where I'm from in Galena, it's about an hour and a half southeast of us. Nice little town. Claims to be the birthplace of Ronald Reagan, but that's not true. He was actually born in Tampico, Illinois. You probably already know that. But anyway, Rita Crundwell was an employee that began working for the city of Dixon in 1970. And I think she started working when she was still in high school. It was her hometown. She graduated from Dixon High School. And the people that were talked to after the fraud was discovered, here's how they described her. She was sweet as pie. Couldn't find a nicer person on the face of the planet to talk to. These are actually quotes from people that were interviewed by the FBI after the fraud was determined. Nicest person in the world to work for. Sound familiar? If you needed something, she'd get it for you. If you thought something needed to be done, she would do it. So you can see how everybody just had this glowing feeling towards Rita Crundwell. Now, the city of Dixon had no city manager. There was no buffer between the city council and her as a comptroller and treasurer. She reported directly to the council. I think she might have had one assistant part-time that came in. She received all the mail. She wrote all the checks. She got all of those canceled checks back from the bank, reconciled all the accounts, input all that data into the general ledger, and produced the financial statements. So do you see how this could occur? You see how simple this can occur? It occurred. She had free reign. The timeline. She was named comptroller treasurer in 1983. And in 1990, she opened a hidden bank account at one of the local banks. If I'm not mistaken, I think Dixon had 3 bank accounts. They only had 3 funds, which is kind of unusual for a city that size. And the account that she opened was the 4th account at that bank. And I believe that she named that account the Capital Development Account. Something that looked like it was tied directly to the city of Dixon, when in fact it wasn't. So if you understand fund accounting is where your accounting structure is broken up in separate funds. One of the cities I used to audit had 35 different funds. So basically, each fund is like a checking account, and it's not unusual to transfer money from one fund to another fund. Happens all the time. In this case, money would be transferred out of the city into her capital development fund based on fraudulent invoicing for capital development projects. Started in 1991, she stole $181,000. A lot of money. 1991, holy moly, that's 30 years ago. Bought a 28-foot pontoon boat. Had a deluxe buggy top, a wet bar, and a propane grill. Pretty nice boat. Spent over $3,000 on diamond rings. Doesn't sound like much today, but remember, 30 years ago, okay, inflation, $3,000 today, I don't know, 10, I don't know. 2 years later, $225,000 stolen from the city of Dixon. And Dixon cut their budget by $150,000. We don't have the money. We've got to cut. We can't do that project we planned on doing. We can't buy that software. We can't buy that piece of equipment. 1995, another 103,000. Now, that year, Dixon reports deficits of $322,000. $322,000. That means their expenditures are exceeding their revenue by $322,000. And they asked, what's going on, Rita? Well, you know the state of Illinois. You know how slow they are in making payments. We haven't received a payment from them for 7 months. Oh, okay. I mean, really? They slashed their budget by $185,000. 2 years later, $328,000 stolen. She bought a custom saddle for her horse, an enclosed golf cart, and a horse named Two Thumbs Up. Yeah, this is true. You can't make this stuff up. And Dixon reports a deficit that year of another $232,000. They're going south here. In 2 years, they're $600,000 in deficit. They cut another $100,000 from their budget. Now we get serious. Now we start to have fun. $1.9 million in the year 2000. 1.9 million. That's a lot of money. That's a hell of a lot of money. She spent $450,000 to remodel and expand her home. Now look at another deficit of $371,000 in Dixon's financial statement. And, oh yeah, we got to cut the budget again. Tens of thousands more in budget cuts. You know what? This is what budget cuts look like to the population. Don't have money to repair the streets. Can't walk down the sidewalks, and we can't repair them because we have deficits. We're lucky we can keep the water and sewer going. This is what happens. This is what can happen. Doesn't happen all the time. But this is what can happen when fraud occurs. How about this? 2002, $3 million in 1 year. Who's looking at this stuff? She buys a motorhome for $300, purchases a horse for $200, buys her boyfriend a 1967 Corvette for $56,000. I'll bet you it was a Stingray, and that was my favorite Corvette of them all. But I'll bet that's what it was. And guess what Dixon does now? We have to have a hiring freeze. We can't afford to hire new employees. We can't hardly pay the ones we got. Look at here, 2005, $4.6 million. $4.6 million in 1 year. In 1 year. Who's performing oversight here? What are these expenditures, fake expenditures for? Well, some of them were for intersections, street work. So if I'm sitting on city council and I know, hey, I drive by 3rd Street and Wakanda Avenue and I'm looking at it and say, where the hell's our new intersection? It's not here. I mean, really? Really? Come on. She builds a horse ranch in Dixon, Illinois for $650,000. In Dixon, okay? She trades the old motorhome. She got sick of that one, bought a new one for $1.8 million. Rita's having fun here. She's living high. And then in 2009, she bumps it up to $5.6 million. Anybody keeping track of the numbers here? She buys a pair of horses for $335,000, a new horse trailer for $260,000, wires $105,000 to purchase a home in Florida. There it is, folks, over a 20-year span, $54 million stolen from the taxpayers of the city of Dixon, Illinois. How the heck did they catch her? Well, 2011, Rita was on vacation. Remember when I talked about mandatory vacation policies, right? We want you to go away for 2 weeks. So we can hire a temporary clerk that comes in and does your job for those 2 weeks, not to replace you, just to keep the thing going, which is what they did here. And guess what? The replacement clerk, when opening the mail, found an account from the bank that nobody knew anything about. Remember what we said about mailing those bank statements to someone other than the same person responsible? Okay? You can talk directly to the bank and tell the bank, any account that's associated with the city of Dixon, with Joe Davis County, whatever, Carroll County, I don't care where you're from, send those statements directly to the treasurer. It would have been discovered a long time ago. She took it to the mayor, of course, and the mayor, I bet that was a bad day for him. You know, I bet that was an awful day for him. He calls the FBI. And in 2012, she pled guilty to the fraud charge. She was sentenced to 20 years in prison in 2013. She was released this spring. I don't know if you're aware of that, but she was released this spring. I don't know why, but much to the consternation of the city of Dixon. She was released. Where did the city of Dixon go wrong in this thing? There was no segregation of duties. Nobody between those charged with governance, city council, and Rita, who had control of everything. No oversight. Nobody on city council asked any questions, other than once in a while, how come we're broke all the time? But you know what happens on these city councils? They change. This fraud occurred over a 20-year period. So if you've got a 4-year term, that means the whole environment changed 5 times during that fraud period. Okay? 5 different mayors, maybe, maybe not. They stick around for a while sometimes. But you can bet those council positions changed 5 times. Every time it changed, the past was forgotten. We quit talking about what happened in 2000, in the year 2007. Nobody was around then, right? Again, she was a trusted member of the community. But trust without verification can lead to disaster. How did she perpetrate her fraud? Well, she opened the unauthorized account, we know that. She explained the deficits as the state of Illinois being behind in payments, but the real thing was 159 fake invoices that the FBI found during their investigation, and here it is. This is the same invoice that I brought up earlier in the presentation. And whenever I did an audit, especially municipality, I would always do the capital expenditures myself. Those are the big ticket items: buying equipment, fire trucks, putting streets in, water, sewer, things of that nature, where if there's going to be hanky-panky, that's where it's going to happen, most likely. And it's going to happen to the extent that it's going to be pretty good sized. So let's take a look at this invoice. Neiman Counseling Center, LLG. Anybody want to tell me what an LLG is? I've heard of LLC, never heard of an LLG. I have no idea what that is. Okay, so they're based in Freeport, blah, blah, blah. Over on the right-hand side, invoice number 10. Number 10? They haven't been around very long if that's only their 10th invoice, right? But yet here's a bill for $74,000. So I think, wow, that's pretty good after only 10 invoices. Date of invoice, November 31st, 2014. If I'm not mistaken, November only has 30 days. And believe it or not, one of the invoices that she used to perpetrate the fraud was dated November 31st. Where's the auditor here? You know, where's your auditor? Okay, quantity, we've got 100. Well, let's wait a minute. Net terms are net 90. Net 90? Come on. I've seen net 10 and net 30, but never net 90. Who gives somebody 90 days to pay? Really? I don't think so. Quantity, 100 and 200, adult counseling, child counseling. I guess it can happen, but in all honesty, I can't tell you the number of times that I have not seen any invoice that was totally rounded like this one. Nobody bills for 100 hours. You bill for 99.5 or 101.3 or 100.5. But that happens twice, so it extends out to $65,000. The tax is $9,700. Whoa, that's a big number. What's that, 15%? I mean, Illinois is bad, but it isn't quite that bad. So $74,750. Okay, now comes the payment information. Direct all inquiries to somebody who doesn't really matter. Make all checks payable to Betty Neiman, okay, Neiman Consulting, LLG. And send those payments to 565 Highway 11, Platteville, Wisconsin. What? Why am I sending payment to Wisconsin for a company that's situated in Freeport, Illinois? So if I'm looking at this invoice, I would be talking to a lot of people. You know, I'd be talking to the controller, I'd be talking to the mayor, the CEO, whatever, board of directors, president of the board of directors. Then it would really start getting interesting. But this is how she did it. She would prepare a fake invoice, mail it to herself, record the invoice as an expenditure, transfer money from the general fund, water, sewer, whatever, into the capital development fund, which is her fictitious fund, and then she would make payment to herself out of that fund to the tune of $54 million. I mean, that's just absolutely amazing. That's absolutely amazing. I mean, what did it do to the citizens of Dixon? What if you're on that council? What if you're mayor? It doesn't have to be 54 million. It could be 100,000 if you're on the Chamber of Commerce of Springfield, Galena. It could be 10,000. Doesn't make any difference. What do you say when your constituents and your neighbors come to you and say, Pat, what the hell were you doing? Were you sleeping at those meetings or what? Huh? What are you going to say? What about your kids? What if you have kids? Kids go to school every day. And we know kids treat each other just like angels, right? You bet. I'll bet you some of the people who served on those councils had to move out of town because of the grief that they were getting. Restitution. Remember I said insurance is about your best bet here? The insurance company for the auditing firm, Clifton Larson Allen, wrote a check for $35 million. Clifton Larson Allen wasn't supposed to be doing the audit because they were doing the consulting on behalf of the city. They went to a local CPA and said, I'll tell you what, we're going to do all of the work. All you got to do is sign off on the report, which he did. So his insurance company coughed up $1 million. The bank, I don't know what the hell the bank had to do with this, but the bank came up with $5 million. And then the FBI sold off some assets that she still had in possession, and I think they generated about 12 to 14 million from those sales. So the city recovered almost all of the money that it was defrauded out of. But again, at what cost? Those things can happen. And as those charged with governance, which you are, all of you, you've got that fiduciary responsibility to that organization. Whether it's your electric co-op, your chamber of commerce, some trade association, doesn't make any difference. You're there to call the shots. And that responsibility falls back on you. And the one thing that I really, really hope, if nothing else, you take from this presentation is any one person in charge of a transaction from the beginning to inception to the end is a problem. It's a problem. Ask questions. There's no such thing as a dumb question. No such thing. So I'm going to end this presentation the way I usually ended all my audit presentations over 32 years. Say, there's my phone number. There's my email. If you have any questions, call me, and I'll be happy to chat with you about any subject you want. So over 32 years, we're doing about 35 audits out of our office. How many phone calls I got? Uno. I did get one, which impressed the hell out of me, because nobody calls. But that's what your auditor is there for. You're looking at a financial statement that they've opined on. If you have questions, ask the auditor. They're there to help. Thanks for your attention. Really appreciate it. Wish you all the luck in the world. Thanks.